This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show. The current state of the UK equity market is concerning even to the self-professed global investor. And it's not just the lackluster performance relative to, say, the US or Europe. As of the end of May 2024, the UK equity funds have had 36 months of consecutive outflows, totaling over £22 billion. The picture is even more dire when you look at the dwindling number of listed companies on the UK stock market and dwindling number of new IPOs. The truth of the matter is that the UK equity market is not only struggling to attract new companies, new listings, existing listed companies on the UK stock market, such as Shell, are looking at going elsewhere. And you know the UK government's answer to this? GB ISAs, basically telling people to invest more in the UK when in fact they are moving their investments out. And now, to top it up, you have new revelations that MP's pension scheme have actually been underweighing the UK equity market relative to the global market capitalization. And with me to discuss this is the man behind this revelation who's actually done a lot more work, a lot more thinking on this than I could ever hope to. I'm talking about none other than Charles Hall, who's the head of research at City Broker Peel Hunt. Charles, welcome to the show.
Thank you for having me, Abraham.
For the purpose of our audience, mostly financial advisors, people in the financial services generally, give us a little bit of a background on your career.
So I started at Casanova just a few years ago, right. And we may come back to it, but back when I joined Casanova, the whole system in the UK worked really well. And that's a lesson for us that it's the last 25 years are wrong rather than we used to get it wrong. And then last 15 years, I've been head of research at Peel Hunt, the UK's leading independent investment bank. We've been building up a franchise of terrific companies that we act for. We act for 150 companies, all the way down from FTSE 100 companies down to AIM businesses as well. So we're really excited about the potential of Peel Hunt, and hopefully we're at a turning point in the UK market.
And a big part of what you do at Peel Hunt is helping companies go public, list on the UK stock market.
That's absolutely right. And one of our core functions is to provide growth capital to companies listed in the UK. That's not just UK companies, but it's mostly UK companies. Why does this matter? The beauty of equities is it's permanent capital. You'd never have to refinance it. The coupon never goes up. You don't have to pay a dividend. So you have that capital forever, and it enables you to take a long-term view about the potential of your business and the ability to invest. And over the last 15 years, there's been a fixation with private markets. There's been a fixation with debt funding. That's fine when interest rates are 0 to 1%. It's not fine when interest rates are more normal, and hopefully they'll come back a little bit, but they're never going to go back down to that 0 to 1%. That was an extraordinary period. So we need to wean ourselves off that debt financing and get back to equity financing.
So we'll come back to this because this has serious implication for, innovation, job creation, all that stuff.
Yep.
But the UK equity market is really, really struggling.
Yeah, tell me about it. I feel it daily. We do UK companies and we talk about them to global investors. So the UK investors are really important to us. But over the last 10 to 15 years, the global investors are really important. And the reality is there's been a dearth of appetite for UK equity markets. And sadly, a lot of this is self-inflicted. And this is because we have globalized our investment. We are world leaders at sending our capital overseas. Look at other countries, they don't do it the way we do it. So effectively, we have created the atmosphere for the UK equity market to underperform. Now, there have been a few little political issues, a few economic issues, maybe COVID. So there are a few things that haven't been going our way. But bottom line is, if you starve your companies of capital, it is no surprise that you don't get growth in the economy. And that's exactly where we are.
So help us understand the scale of this problem in terms of, not just performance of the UK equities, but also things like inflows or net outflows.
Yeah, sadly, outflows.
And also, listings, and help us understand how bad is it?
Well, it's been pretty bad, and the last couple of years have really encapsulated it, but this is a situation that's been building for years, and really you have to go back to pension changes.
Right.
And pensions at the heart of this.
Okay.
Pensions are a huge asset for the UK. We have the third largest pension market in the world, and yet our pensions do not invest in growth assets. Let's not go through all the details as to why that is, but the reality is for the last 25 years, pension funds have been selling out of equities and selling out specifically of UK equities. And our pension funds have gone from over 40% of ownership of the UK market down to more like 4% today.
Wow.
And that is £1 trillion worth of assets that have effectively gone from the UK equity market. Now, our entire UK equity market is £2.5 billion. So the maths just tells you that this wall of money exiting the UK, that is precisely why we have got ourselves where we are today. And if you have money exiting a market, that impacts directly on valuations. And so this is a self-fulfilling issue. People call it a doom loop, quite rightly, because exiting money creates low valuations. What happens then is that those companies become ripe takeover targets for private equity and overseas companies. And we've had a slew of acquisitions over the last few years. That's reduced the number of companies listed in the UK, down 20% in only 5 years. 5 years! This isn't a small issue, this is a big issue. And then what it also means is, why would you want to IPO? Valuations are low, there isn't much capital around, investors are really wary with the money they've got. So the IPO market doesn't function when you have outflows, it functions when you have inflows. So the demand side is a really important piece. Now, the good news is that we're doing something about this. And so I don't want people to be despondent and think, oh my goodness, the UK, it's a dinosaur market, it's a dying market. I don't believe that at all. The changes are going to be really meaningful. And what we've already got is some really important changes on the supply side.
We'll come back to the
changes. Let's do that.
We'll come back to the changes, but just let me understand this. Again, a lot of our audience are financial planners, so these are bread and butter issues that they're dealing with.
Yeah.
Pensions is a big part of their work. Now, in one sense, you're saying that we've essentially lost about 8 trillion of assets, and for context, the whole of the UK capital market, equity market today is about what, 3.5, maybe 4,
Not as big as that.
Trillion?
Less than that. Yeah.
Less than that.
Yeah.
And so you're saying we've lost,
40%.
40%.
Yes.
And we have 20% less companies listed on the UK market than 5 years ago.
Yep.
Okay. Now, the one thing that you also alluded to, which I am, slightly happy about, is that you didn't say that index fund, passive investment is responsible for this. You said the shift out of risk assets, equity, into bonds largely for the for the most part. I would argue probably in DB pension schemes. But also, I guess, even this move towards global asset allocation as opposed to UK equity.
Yeah, and so I don't blame the passive funds, and I can't blame passive funds.
Well, they blame us for everything.
They're very good products and they're very cheap. So I can't criticize them at all. The reality is that they pour fuel on the fire of the issue that we've got. Because if you are going into passive funds, typically you are going into large cap. And this is causing the major problem we have got in the UK of not funding our growth businesses. We'll probably come back to that.
Small and mid cap.
Correct. Yeah. And then, so that was the first piece, is that you go into larger. And then the second piece is you typically go into global. And then when you go into global, as you'll know, the US is 70% of the developed market. So every £7 of every £10 you put into a global fund will inevitably go into the US. So effectively, UK citizens putting money into global passive funds is taking wealth out of the UK and putting it global. Now, as an individual, I cannot criticize anyone for doing that. If we all do it, we starve UK companies of capital. If we starve UK companies of capital, it is absolutely inevitable that we do not grow the UK economy. And so our wealth creation diminishes. So I talk about it as selfish investment. The UK, we are brilliant at selfish investment. Pension funds, they are selfish. Charities, they're selfish. Retail investors, typically they're selfish. Individually it all makes sense. But add it together and it's a disaster. And so this is why so many countries around the world are rethinking about their capital allocation. They're rethinking the incentivization structures. And they're recognizing that keeping capital at home is really important. The problem with the UK is that we have this feeling that we are a sort of global leader and we should be allowed to put our money everywhere. That's fine if you accept that that is going to diminish the UK equity market and impact on the overall growth of the UK economy. And if you live in the UK, you probably care that we can create economic growth in the UK. Because if we are going to be funding our National Health Service, our Ministry of Defence, everything about that we want funded, that can only be done out of economic growth. We all know, Labour said it, Conservatives said it, there is very limited ability to raise more money through taxation. There's very limited ability to cut costs. So the only way you can do it is by growing the growth rate and accelerating faster. And the only way you can do that is through investment.
This is powerful stuff, by the way, Charles, and I know you're neck deep in this, but just for a second, I just want to acknowledge the importance of your work and others in this space, because this is important stuff.
Yeah, it needs saying, and I think we've started to recognise that a lot of us are just passengers, and we just accept the system as it is. And actually, we need to be thinking more deeply about it. We mustn't accept that politicians have all the answers. We've got to provide them with the answers. And I spend quite a lot of time with Treasury and with regulators, and they're very bright people, but they don't speak to companies in the way that I speak to companies. They don't have that access. And I have far more knowledge of what is going on in pension funds within companies, with their ability to grow their business, the constraints that they have, than Treasury does. And so I recognise that it's up to the likes of me to stand up and say, look, we are doing things wrong. The great thing is it's in our hands to put it right. And now is a really fundamental time to do that. We've got a change in government. I think we can say that. And just as importantly, our pension funds, for the first time for getting on for 20 years, are in surplus. That's really important.
Okay, so this is interesting. So now let's start to talk about the solutions.
Yeah.
So you've thought about that, and you've written extensively about that. So talk to me about what sort of policy reforms or changes do we need to address this issue?
Yeah, so 4 buckets. I'll give you the politicians. I'll do the Rishi Sunak. These are the 3 things you have to remember. Anyway, so it's pensions.
Pensions.
It's A UK ISA.
Yes.
We call it a UK ISA rather than a GB ISA because we have to include Northern Ireland. And it is stamp duty.
Stamp duty.
Stupid tax. Let's come back to that. And a wealth fund. Four things.
Four things. All right. So let's start with pensions. What needs to happen with pensions?
Total rethink of how we deal with our pensions. The vast majority of people in the UK have literally no idea what their pension is invested in. They probably have no idea the sum of money they have in their pension, and they have absolutely no idea how much it is going to give them when they finally retire. This really matters, and we are unusual. If you are living in the States, you would do your 401k.
Yeah.
Everyone in the US knows what their 401k is in. They care passionately about it. If you're in Australia, it's headline news when people are talking about the pension fund return because everyone understands that that is fundamental. So we need to have a rethink about how people are educated about pensions. So that's one aspect. But there are numerous other aspects. We have to get them investing back in the UK. Just think, all of those people in those pension schemes are living and retiring in the UK. All of them care passionately about how the UK is governed, how much it grows, how much we're able to raise in taxation, how much we fund our services that we all rely on. So if our pensions don't invest in the UK, we effectively ensure that we have a low growth economy. If they do invest in the UK, we can accelerate the growth in the economy. That is the biggest asset that we have outside housing. Now, we can't do anything about housing. We can do something about pensions. So compare and contrast. In Australia, the leading Australian super funds, they typically invest 20 to 23% of their assets in Australian equities. That is 10 times overweight. Our DC schemes, even our workplace pension schemes, they might be 5 to 6% invested in UK equities. That is marginally more than what they should compared to our global asset allocators would tell us. So Australia massively overweight, we are not. When you look at an Australian pension fund, the Australian Super is one of the big ones. They have not only a really good performance, miles better than the ones in the UK, they also are loud and proud about investing in Australia in order to grow the economy, grow jobs, grow tax revenue, help them get to net zero, loads and loads of positive affirmation about why you, as a contributor to the Australian Super Fund, are making a difference to the whole economy. How many people in the UK even have a knowledge of what their pension fund is doing? Vast majority, none. So that is really important. And so there's now a debate about how much is allocated to UK companies, both private and public. And I think it's really important, this. We shouldn't just think about the equity market. It's just as much about private companies. They need the growth capital. They need the scale-up capital. And they're going to become the IPOs of the future. And so it's the whole continuum through private growth through to the public markets. That would make a massive difference if they started to increase their allocation to the UK. And they might actually find that they get a better performance because we have some of the worst performing pension funds in the world. The Americans perform better than us, the Canadians, the Australians, the Swedes. The reality is we have had a whole series of policy mistakes that have cost the UK billions, if not trillions, over the last 25 years. Now, because we have schemes in surplus now, we can look at the DB schemes. Because we now have workplace pension schemes, we can look at those. So much can be done to regenerate productivity growth in the UK. So that's another piece.
So, hold on a second.
There's lots of things to go through there. We could talk just about pensions.
We moved into this. So what you're proposing is some sort of, policy change or rule.
Hold on. I would say the first thing, and Jeremy Hunter now announced this in the spring budget, DC pension schemes are going to have to say how much they invest in the UK.
So disclosure?
Disclosure is, once you know, That is helpful. Most of the time, most of our funds, you cannot even tell how much they've got invested in the UK. So disclosure is important. And once you go through that disclosure process, people are going to ask questions. People like me, people like you, we are going to say, so you've got 5% in your fund and it's underperforming. This fund has 10% and they seem to be outperforming. Just explain that. So I think shining the spotlight on is going to be really important. It's going to be really interesting to see what the Labour Party do. I suspect that they are going to be more on the front foot in saying what they expect. It may not need legislation, it may not need rules, it may just need a delivery of an expectation that says investing domestically is important. If you're not doing it, we're going to be looking at taking further measures. And so I think having that driven into our mindset that investing domestically is good, that will be really helpful. And follow the money. If we increase capital investment in the UK, that will accelerate growth. That will mean that our assets perform better. And funnily enough, that might be good for the pension fund as well as the economy. So this isn't trying to say, oh, you've got to invest in the UK just to be patriotic. That's nonsense. It's actually investing in the UK to improve performance and to deliver your commitment to the UK. And bear in mind, in a pension fund, you get massive tax breaks. You know, these are really attractive tax breaks. This is effectively funding out of taxation to enable you to put money into your pension. You should give something back.
This is the angle that's been put forward to say, well, you can invest your money anywhere you want in the world, right?
Yeah.
But when it comes to tax relief that comes, from pensions or tax available in pensions, then perhaps the government reserves the right to influence how that money is invested. But you're not going right now so far. What is your ideal endpoint? Because part of this problem, I think, is that we're tiptoeing. We come to a gunfight with a knife. We bring a knife as a nation, right? Like we bring a knife to a gunfight, right?
We've got a pea shooter, actually.
Right? So
I'm afraid.
Right. So
Yeah.
So my point is the ideal solution just to say, you're going to get 20% tax relief or 40% tax relief, whatever it is. We expect a proportion of that to be invested in UK.
You have to do each pot differently because there are different priorities for each pot. So let's leave DB schemes because those are more complex.
Exactly.
Let's look at DC schemes and local government pension schemes. On average, they invest 9% in the UK equity market, and some of them are a lot lower than that. I think they should probably be getting 20% plus. That's the sort of level that makes a meaningful commitment to growing the economy. And just bear this in mind. This trend to globalization sounds great, but what happens if sterling strengthens over the next 10, 20, 30 years? Every person that has gone into a global fund loses out. So it's not a nirvana to go global. And over the last 20 years, it's absolutely been in your interests because unfortunately, the UK has been a bit of a mess.
Yeah.
And our currency reflects that. So our currency has come down, which means that if you own overseas assets, you've actually done better.
Yeah.
But how do you know that that's going to be the case for the next 20 years? I hope it's not. I hope over the next 20 years, we actually grow our economy, we invest in our assets, and actually sterling strengthens over the next 20 years, in which case you want to have domestic assets, not overseas assets. And this is something that, bizarrely, no one talks about. The consultants go, oh, no, you've got to go global, got to de-risk. Well, actually, you're increasing risk because unless you're intending to live globally, and most of us don't, you are actually increasing risk.
I mean, so this is fascinating for me. For us personally, as a company, we manage now, over 6 billion of people's money, and we are most of it, is in pension, self-directed pension. So I'm interested in what your thoughts on self-directed investors are, using financial advisors, that sort of thing. But the argument's always been, look, global asset allocation, we take that as an input, right? That's what the market's telling us. And so we do that. What you're suggesting is that, well, first of all, it fits a cycle. It's a self-fulfilling, it's a vicious.
100%.
Well, for the UK, it's been a vicious.
Yeah.
For the US, it's been a
Virtuous cycle. Yeah.
virtual cycle. But then you're saying, well, actually, in return for the tax relief that you receive, and thinking more long term and for posterity, where you live as a person, as an individual, unless you got other plans.
Yep.
There is a trade-off.
Well, I think that's right. We have responsibilities.
Yeah.
You know, I love the fact that I can put into my SIP or my ISA any company I like around the world. Isn't that terrific for me as an individual? But as I go back to it, selfish investment means what's good for me as an individual is not necessarily good for the country. And this is, for me to get a tax advantage to invest overseas, it's crazy.
And we'll come back to the other raft of measures later. But the thing that supports global diversification, global allocation, though, is the fact that virtually all of the breakout companies, this is where I disagree.
Okay.
I struggle with this framework a little bit, because it's, in my mind, we're dealing with the secondary issues, right?
Yep.
In other words, fund flow and money, pumping money into the market. The fundamental thing, the issues are, who are the biggest companies in the world? Who products and services that you use. I saw your iPad earlier on. I'm wearing an Apple Watch, all that stuff. Apple, Facebook, Google, all these companies, they are American companies. And that's where I want most of my money to be in, And then when we look at the UK companies, well, which companies excite us? The biggest one is Shell, and, and you say, that doesn't quite inspire you, drilling hot.
Okay, so there are a few things here,
Shut me down. Tell me.
So I cannot complain at all if you invest your own money in overseas assets.
Yeah.
Where I think I would question it is, should you be given a tax benefit in order to go and invest it? So no issue whatsoever about global diversification. I do it myself, totally fine, but I don't think I should get a load of tax relief, or I should give something back if I get some tax relief. Then the other piece is, we have some brilliant companies in the UK, but what typically happens is they get to a size and they get acquired.
Thank you. Yeah, that's true.
And then not only that, we wouldn't be having this debate in anywhere near the same level of intensity if ARM had floated in the UK.
Right.
Why did ARM float in the States? ARM is a brilliant British company. Yeah. It's grown from Cambridge. It's one of the best companies in the world. Most people want to have an ownership of ARM just as they would of NVIDIA and various other companies. And yet it went to the States. Why did it go to the States? Because the valuations they get out there are perceived to be better, and they have more investors out there. Now, the reality is, if we had a properly functioning UK market, ARM would have listed in the UK. And then we would have loads of people saying, I want to put more money into the UK. And so this is the issue. We have in our universities some of the best minds. We are going to create some of the best companies around the world over the next 20 years. But if we do not fund them, and they go and list in the States or get bought by some of these Goliaths in the US, effectively we will never see them. And one of the things to think about equity markets is that they are totally democratic. Anyone can buy into them. The issue I have about private markets is that the rewards tend to go to very few people, and the general investor has no ability to own those assets. So actually enabling companies to grow, develop, build jobs in the UK, and then IPO in the UK should be an aspiration. Again, I'll come back to the point, is that we are the ones doing it wrong, not everyone else. Look at France. So what France is doing is that they are creating funds, government funds, to then cornerstone IPOs. There was a recent one earlier this year. Significant cornerstone investor was Caisse de Dépôt, a French government-controlled funds. Now, we don't have anything like that. So they are actively promoting companies in technology floating in France in order to build their technology space. Are we doing that? No, we're not.
So we're jumping into your fourth solution.
Oh, well, hold on. We've got a few more.
Let's go.
I've got to finish off with pensions first.
So pensions,
So one of the things that we have to do, and this is a social aspect rather than it being about equity markets, albeit there is a side benefit. Our pensions are woeful. We do not put enough money in. 40% of people do not even put money into a pension at all. But the workplace pension schemes that we have, the amount of funds in them are so small, they are not going to create the pension that people think.
Yeah.
And this comes back to the lack of knowledge that people have about pensions. They have no understanding that either they're going to have to carry on working into very old age, or they are going to be reliant on the state pension and have a very small top-up. What we have to do is increase the amount of money that gets put into pensions every year. And maybe you'd have agree with this because it might be to your benefit. But we currently put 8% in.
Yeah.
Now, if you go to Scandinavia, that's more like 15 to 20%. Now, Australia are just putting up their rates. Ours is 8%. It's just not enough. We need to be moving that up towards 12 to 15%. Now, you can do this over time because a large number of people contributing to a workplace pension scheme are in their 20s and 30s. They've got time. But if we don't do anything, then inevitably they are going to retire with a very small pension. So that is absolutely crucial. And I hope any new government takes that really seriously. Why is that helpful for the markets? Is that more money going into growth assets would be great. If we do that and people put more money into their pensions, we get a virtuous circle. It won't be very helpful if we put more money and it just flows out into global markets.
And I couldn't agree with you more on the pension contribution. That needs, everybody needs to, employers need to up their contribution, employees we need to get closer to that, to that 15, 20%. And we've done this before with auto enrollment, bringing that in. But, we got to say, actually, we're going to increase this by 50 basis point every year from the 8%. So we say, okay, 0.5% every year or 8% every year. And in 5 years, we'll get to the point where people are putting 15, percent or so under a decade into their pension scheme. The one thing that amazed me recently was, this is DC schemes, where I was up north and my sister said to me, have a look at my pension. This is a national organization, company. And, she is less than the age of 40. People are trying to wonder how old is Abraham. And my point is, and for a, 30-something-year-old who's not going to see this money for 3 decades, not going to touch it, right? She's in a 50-50 or
it makes you cry, doesn't it?
It makes me cry. The speed at which I click those buttons to help her to move the money into 100%.
And guess what? This is one of the main themes that is at issue in the UK. We are obsessed by risk in a bad way. Now, risk has both aspects to it. It has positive sides and it has negative sides. The last 25 years, we've absolutely fixated on protecting pensions.
Yes.
And that goes back to Robert Maxwell generations ago, and we're still in that same mindset. No,
of course
they don't. But this is the issue that we're still living with today. Is we've got to protect our pensions. Pensions are sacrosanct. Well, actually, the biggest risk is you don't grow your pension. That is the risk. And if you don't grow your pension, you're not going to have a pot that is going to give you enough money in 10, 20, 30 years' time. And so this is the problem I have with the UK pension market, is that we have gone into low growth assets because we want to protect the value. But that in itself is disastrous for anyone in those schemes.
These default funds is another area that needs to be targeted. So have we done enough on pensions?
Yeah, let's move on.
All right, let's move on to, I ban people in our company. It's a sackable offense to say buy, sir. So you're saying it's UK ISA, not GB ISA.
UK ISA.
Because we don't want to discriminate against
Correct.
Welsh.
I think Wales is in GB.
Wales is the Northern Islands.
Yes.
Okay, so let's talk about. I mean, when the chancellor announced this as part of reforms, the thing was, seriously, another ISA is what we need. He adds, in my mind, he adds to the confusion. There's BISA, there's JISA, there's cash ISA, there's, equity ISA. Now what is this? It's GBN
ISA? Yeah.
So persuade me, our listeners, why this is such a good idea.
So I am 100% in agreement that we need to have simplicity in our ISAs, and some of them are just ridiculous. They haven't really worked. The innovative ISA, who cares? Why do we still have an innovative ISA? It was a peer-to-peer lending was a sort of theme that lasted for about 5 minutes, and it was mad that got put in place. I think it's mad that we have a split between cash ISAs and stocks and shares ISAs. Yeah. It's mad that we encourage people to put cash into an ISA in the first place, to leave it there. That's not the philosophy of an ISA at all. So I think we could crunch down on the number of ISAs. Having said that, a UK ISA, I think, will really resonate with a large number of people who live in the UK. And you may have seen that AJ Bell did a survey of their ISA holders, and more people said they wanted to do a UK ISA than a stocks and shares ISA. So there's a lot of appetite for a UK ISA. And this is because people are genuinely patriotic. They want to invest domestically. And actually having something that says, I'm just putting money into the UK, and that is going to benefit the UK economy, people think that's good. Funnily enough, they might actually do quite well. That's not investment advice, but they might, because the UK has performed so badly. So the question is, how popular will it be? I think surprisingly popular. Will it make a difference? And the answer to that is yes. It's not a silver bullet. It's not resolving everything, but it contributes to reversing the outflows that we have seen for the last 3 years. And my estimate is that it could bring in about £4 billion a year. Yeah. And people say £4 billion against a £2.5 trillion stock market. Oh, it's tiny. It's not going to make any difference. What they're missing is and you identified it, it's the outflows that count. Yeah. Because why do share prices go up and down? It is the fund flows that drive it. It's not the overall stock market. The vast majority of people do not trade. The vast majority of funds do not trade. The drivers of share prices up or down is the people who do trade and the new money going in. So if we had £4 billion of new money going in every single year, that adds up to a lot of money on a 5 or 10 year basis. And this will provide the stimulus to these UK companies to actually make a difference to them. And I think one of the important things to try and get your head around is, why does it matter what the share prices of companies are? Now, do they not just carry on doing what they do, and the share price is just it sort of exists in the ether? The answer is it really does matter, because we are living in a global market. Our companies are competing generally globally. And if you want to grow and want to raise more money to grow faster, the share price of your company and the valuation of your company really does matter. And we've seen this in spades with Shell, and that comment a few months ago by the CEO saying, we will need to look at where we are listed. And the whole reason for that is a combination of, if we are valued higher in the US market, then we have more opportunity to grow, either through acquisition or through issuing shares to go and invest in energy transition, whatever it might be. And funnily enough, our shareholders would like us to be valued higher, not lower. Yeah. And there are an awful lot of shareholders who will be telling us we should go and relist in the US. So that is a proper wake-up call. And I've talked about it before, but if Shell was to decide to leave, that is cataclysmic for the UK market. It really is. And the reason for that is the domino effect. It wouldn't just be Shell. Every other FTSE 100 company would be asked by their shareholders, have you considered it? If not, why not? And now we have a global investment market. 60% of the FTSE 100 is owned by overseas investors.
60%?
60%. So as a result, it's not UK citizens that are determining the actions of those companies, it's global investors. And if the global investor says we are going to get a lift up in our share price just by moving from the UK to the US, then the company has to consider it. Yeah. And think through the implications of if Shell was to leave. Shell pays huge dividends to UK citizens. Would they still pay those huge dividends if they were listed in the US? Might do, might not. But those dividends pay tax to the UK taxpayer. That's really, really important. That is billions. Then you have to think about all the people that Shell employs in the UK, far more than probably people even consider, because they think of them as global asset owners of assets. Actually, we still have a lot of people being paid in the UK, paying their taxes in the UK, investing their money in the UK. All of that goes. Then you have the whole financial ecosystem that sits around them. Bankers, lawyers, accountants, auditors, PR people. The list goes on and on and on. The financial market contributes 12% of our GDP. It is one of our best industries. For the last 15 years, we have effectively allowed our financial services industry to slightly wither. And that's been part of the blowback from the global financial crisis, is reining in the banks, reining in risk. And we went too far.
It's going too far.
Miles too far. Yeah. And as a result, that is one of the reasons why productivity in the UK has been declining. Yeah. And that is why we need to keep more assets at home. So, long-winded answer, but what we have to do is make sure that our valuations are appropriate for our companies. And that has not been the case. And that is why so many of them are being acquired. And when they get acquired, we potentially lose the growth of those businesses forever.
So what should be in GBIs?
So UK assets. We'll try and get stick to the script. Come on, Abraham. So the Treasury has put out I think a very thoughtful document to discuss all of this, and they've been listening to lots of different people. One of the things they've suggested is putting gilts in. I think that makes no sense at all. Now, this is all about growth assets. Putting gilts in just doesn't cut it for me. Corporate bonds, potentially. But I think what you have to do is say this is applicable to any company listed in the UK. This is a UK stock market issue, which everyone in the UK should care about. Even if they don't own a single share, they should care about the UK stock market, because that drives economic activity, that drives tax revenue. So everyone should care about this. So my view is we should allow the UK ISA to invest in any company that is listed in the UK and any fund that has the majority of its portfolio in those companies listed in the UK. And I say listed rather than domiciled. If it means that we attract companies to come and list in the UK, terrific. That's brilliant. That brings wealth into the UK. That means that they're likely to have their head office. They're likely to employ people. They're likely to employ bankers and auditors and accountants. All of that extra activity then comes to the UK. So that is good news. We shouldn't be shy about that. We should be thinking about what this does for the whole UK market. And at the moment, it's proposed at £5,000. Now, everyone should think, well, that's terrific. We're increasing the ISA allowance. I think that's a great thing. You probably know 800,000 people took out the full 20,000 allowance last year. Hopefully that means that 800,000 people can take out an extra 5,000. Who knows? We'll see. But it's a significant increase for people who are investing through the ISA. And I think that's really important, because capital gains tax has been changed. Dividend taxes have been changed. It's really important that we enable people to grow their nest eggs through their ISAs.
So you've heard him. The country needs you. $5,000 a year is not a lot. And I agree, we shouldn't conflate it with other things, these guilds, corporate bonds and all.
Makes no sense.
Just by the way, though, do you think that part of the push, certainly for DB schemes, this is the cynic in me talking, towards low-risk assets, bonds and gilts, is because it ultimately makes it easier for the UK government to borrow money if there's a massive demand?
That's been the impact. I think that has been incredibly damaging for our economy.
Yeah.
This could be a whole nother podcast, quite frankly. So, but just in 30 seconds,
Yes.
we had interest rates far too low for far too long. And what that meant was that we didn't put money into growth assets, we stuck it into low growth assets. And that includes property and bonds.
Yeah.
Now, it meant that the government could borrow cheaply. I think that has actually been incredibly damaging. They could have made it brilliant. What they could have done is issued a 100-year gilt, and that would have been the best investment the government could have ever made. They massively missed an opportunity. And so as a result, what happened was we increased our state spending more and more and more. And as a result, we're now facing a situation where the government debt is so high that actually the only way we're going to address it is by growing the economy. So I think the unintended consequences of having ultra low interest rates was partly fueled by that push of DB schemes. And it's a headache we're going to live with for the next 50 years.
There's so much more I want to ask you. So your third,
stamp duty.
Your stamp duty, that's counterintuitive because you're actually saying the UK government should give up revenue.
100%. So why is because it is a frictional tax that is disadvantaging UK companies. We operate in a global market. The US has no stamp duty. They looked at it 5 or so years ago. They looked at it and went, this would be a disaster. This is a way of ensuring that we reduce the competitiveness of our companies. We reduce the desire of people to invest in the stock market. Just give you one example. If Shell moves from the UK to the US, you will no longer pay stamp duty.
Of course.
How crazy is that? So it only raises 3.3 billion. Now I say only. It's a big enough amount of money that it matters. But the negative impact it has on our economy is really significant. Lots of overseas investors do not invest in the UK because they go, you have this crazy tax. Even France does not tax small and mid-cap companies on stamp duty. Now, any economist could tell you frictional costs are bad taxes. Now, that's fine if it is just a domestic market. So stamp duty for houses, that I disagree with the scope of it, but you can collect it and it doesn't damage you internationally. This damages us internationally. It's getting smaller and smaller because we're effectively reducing the size of our stock market, and it is part of the problem. And the counterfactual is, if we actually get rid of stamp duty, we will have a faster growing economy. So it's actually positive. The problem the Treasury has is that in the way that the OBR budgets get done is that they say, oh, 3.3 billion, we've got to replace it. But that's the wrong way of looking at it. Actually, the reality is if we don't get rid of it, it's going to cause us generations of problems.
What about the argument that says, well, you're not doing long-term investors any favors by getting rid of stamp duty? Most of the benefits going to go to hedge funds, day traders, buying, selling.
They don't pay it.
Okay.
They're far too sensible. They use CFDs and other products which don't pay stamp duty. How crazy is that? Is that we set up a system that enables you to avoid a tax. So the people who are paying it are the average people who are putting money into the market on a daily basis, the retail investor, and it's people investing through their pension. So unfortunately, it is being paid by millions of people. So it is a tax on investment.
Your fourth reform idea is wealth fund.
Yeah, wealth fund. So obviously we should have done this decades ago when we had oil gushing, and that was a missed opportunity, but it's never too late to start. And this is the really important point. We have an asset in NatWest that is government owned. It's still 6.5 billion, 7 billion pounds. That could be the start of a wealth fund.
So we sell our holdings in NatWest,
reinvest it in UK small and mid cap. You effectively put growth capital into our growth companies, and this is really important. The biggest companies in the FTSE 100, lots of those grow by cutting their staff. Cutting costs is their main growth tool. And they look at our banks. That's what, every year they're announcing how many jobs they're cutting. Job creation happens in small and mid-cap companies. And this is both private and in public. These are the ones that are the growth companies of the future and the FTSE 100 companies of the future. And these are the ones that we want to nurture and develop. If we had a fund that came out of that asset that we have got, we could probably find that the performance of it would be really rather good. So we'd increase the wealth of the nation by doing it. We'd also stimulate economic activity by putting it in the hands of our younger growing companies. We could also do what France has done, is enable that fund to be available to cornerstone IPOs, so we reinvigorate the IPO market. And just think how good that would be if companies that were thinking about IPOing, instead of thinking, oh, I'll go to the US because that's a bigger market, if we actually had a fund that was based here that says, no, if you develop your business here, we can provide you with UK capital. And this is such an important point. If we provide the growth capital to companies from overseas, guess what happens? Those overseas investors will be saying, why don't you come and IPO over here? Why don't you grow your business over here? And this is the issue we have with the globalization of wealth, is that so many funds overseas are, they're sort of trying to entice you over. Yeah. And why not? They're going, we can help you grow. And of course, an awful lot of these funds are US-based. And they're really smart people, and they've got terrific business models, and they see terrific companies in the UK, and they say, well, we'll help you grow in the US. And guess what? You just start exporting jobs. We have got to have UK investment for UK companies. It doesn't have to be the whole lot. We want to have global investment, but we have to have cornerstones that come from the UK. And this goes back to the start of my career. When I was at Cazenove, when we were doing IPOs, who did we call? We called the biggest pension funds in the UK that were the cornerstones of pretty well every IPO. That does not happen anymore, and that has to happen again.
So your idea for the Wealth Fund is not just to invest, I say, indiscriminately in UK equity or large caps. It should be targeted at
smart money, where you have really good people who understand businesses are doing the investment. I'm absolutely not suggesting that it just gets scattered across all the companies. No, that makes no sense. But if you know that we've got a lot of very smart people in asset management in the UK, very smart active managers, and they've been operating with both arms behind their backs over the last 5 years because of that tidal wave of money flowing out. We still have great companies here. What we just need to do is provide them with capital.
Now, meanwhile, your latest revelation is that whilst the government's been encouraging us to invest more of our own money in the UK with GB ISAs or the UK ISAs, and even things like the Mansion House reforms.
Yes.
MP's pension scheme actually underweight UK equities relative to global capital markets. So they have, you said, 1.3%.
1.3.
Talk a little bit about how did you come across this revelation? What did you find when you looked at this?
Well, we've been looking at a number of pension funds to look at allocations, and thankfully, the MP scheme, you can actually see some of the details.
Right.
Now, we don't see all the companies they're invested in, but we can see whether they're invested in the UK or in gilts or bonds or infrastructure. So the numbers are there, and they've been running these schemes for some time, so you can look back. And what you can see is that this is actually a really recent decision. Now, less than 5 years ago,
right,
they had more like 20% in UK equities. So the actual number is £130 million they had 5 years ago invested in UK equities. Today, £10 million. So they have sold 90%. Now, that's not because I think someone woke up one day and went, oh, the UK market's going to underperform for the next 5 years. What they'll have done is they'll have had consultants in, and the consultants will have gone, actually best practice today says that you need to globalize your fund, you need to have alternative assets, and this is the way to run pensions in the modern market. But the impact is is massively selling out of the UK. And it's no wonder the UK has underperformed over the last few years. And a lot of people have said to me, well, Charles, how can you tell people to put more money into the UK? Look at the performance of the UK. And I just said, well, go figure. We've been selling, all these pension funds have been selling. Of course the UK has underperformed. That's exactly the problem. So it's really interesting that this has happened. It's really recent. So this is not something that has been in place for some years. And I think MPs should be aware. I bet you most of them have literally no idea what their pension is invested in, or have a recognition that the money that they are putting into their pension pot is going off to help NVIDIA grow. We should be helping some of the great companies in the UK grow. And we've actually floated a couple of companies recently, one of which is Raspberry Pi. Great British company. That's the sort of business that they should be backing, not going and backing NVIDIA.
And so I heard this argument that, MPs wouldn't know about this, but I find that not particularly tenable, because surely there are MPs on the trustee
Yes, there are.
board, or the trustees of the scheme. And so you're saying when their consultant presented them with the idea, whatever it was, that we're going to sell down 125 million of, maybe that wasn't the exact figure,
That's pretty close. Pretty close.
Of your money out of the UK, and you're a UK MP. This is
It sounds extraordinary, doesn't it?
people whose jobs is essentially to ask questions, couldn't ask questions and make these connections about what that means, even just the optics.
Exactly. But no, the reality is these decisions were taken a few years ago. When did you first hear about it?
Well, when you...
There you go. There you go. Most people had no idea. And so this happened, and it's buried in a report. And you have to be a boring analyst like me to go into note 22 to find the details that actually says what has happened. And this is the reality, is most people don't care about pensions. And they should, because they are our biggest assets. £2.5 trillion worth of assets in direct pensions. Add it all up to the whole wealth in the UK, it's £5 trillion worth. We should pay a lot of attention to this, and yet we spend more time worrying about our house.
Oh, God.
I've worn you out, Abraham.
No, this is so fascinating. I've thoroughly enjoyed this conversation. The battle I'm having is, do I want to carry on, or do I want to stop? Seriously, there are other questions I wanted to ask you, just on what companies, listings in the UK market, and why it's less attractive. How much has something like Brexit contributed or exacerbated this? Because my thinking was, well, pre-Brexit, if you wanted to invest, you wanted to list, in your decision as a founder or a leader of a company would probably be, do I want to list in Europe or do I want to go to the US? And if you said, well, we're a Europe-based company, or a European, by that I mean including regionally, including UK, geographically, sorry. And if you said, well, we want to invest we want to list in Europe, well, London. So you say, well, so the decision is London, and that gives you, if you like, access, to the whole of Europe. Now, you go through that decision, you say, well, do I want to go to European or the US? And if you decide it's Europe, then you say, is it London, which gives me access to the UK primarily, and I have to go through all this hurdle, in the European market? Or do I go to Frankfurt? Do I go to Netherlands? Even comes up.
But there are a few things. Yeah, absolutely.
Correct. Call out my BS. To what extent has this contributed to the problem?
I think Brexit per se has not been a big impact. It's more the impact that it's had on the UK economy and the perception and reality that we've had a political mess for the last 8 years. And how many prime ministers have we had? Quite a few. We used to be seen as a really stable political and economic country. We used to look at various other countries in Europe and go, oh my goodness, look at them. They are the laughingstocks. We are now the laughingstocks. And that's been the way of the world for the last 6, 7, 8 years, where lots of investors have said, I don't like the UK risk exposure. I don't like the politics. I don't like the economics. I don't know what's going to happen on Brexit. So it's more uncertainty. In terms of the decision to list in the UK versus other markets, the reality is hardly any companies go and list in Europe that are UK-based businesses. Right. And that's still the case. So the draw into Europe is not really relevant. It's really the US. It's the US. And the US is a vortex. It is 70% of the world's equity market. Yeah. And European countries have the same issue that we have. Yeah. And you may wear Birkenstock. Yeah. Probably not, but you may do. Anyway, Birkenstock, German company, goes and lists in the US. And so they've got the same issue that we have got. We're all in the same boat in that sense, and this is the success of the US. And the US is an amazing success story in terms of economic activity and growth in public markets and some wonderful companies. And it's no surprise. What it means is we have to do better to keep companies in the UK, as do the Europeans. And go back to what I was saying about France. France recognized this 5 years ago. They've done something about it. And they've taken preemptive action to ensure that companies stay and grow in France. We haven't yet done this, and we've got to do it. So Brexit is a contributing factor, but actually it's a relatively minor contributing factor. What it comes back to, and why I'm positive about the UK, is we've got regulatory reform. We were going to come back to that. We haven't even started, but that's terrific. Great work's been done there. I won't go through it now, but it's happening, and it's happening now. That's going to change the dynamics for being listed and for IPOs in the UK. So that's great. If we get a UK ISA, if we get pension reform, potentially stamp duty, I can but dream, and a wealth fund, I can dream about that one as well. If we got all of those, we would return the UK to being the preeminent market in Europe and also challenging the US. And one of the great advantages we have is that we have the best small and mid-cap market in the world, better than the US. Right. If you are a small and mid-cap company, you get ignored. If you're a $10 billion company, you get ignored. If you're a $10 billion company in the UK, yes, and you're a really important business. And so we have the best small and mid-cap market in the world, and we're letting it decline. And this is the real issue. If we do nothing about it, it will carry on declining. But if we have a government focused on long-term economic growth, and long-term is the operative words there, that changes the dial. Brexit is then behind us. We've no longer got the whole political shenanigans. We've actually got some stability. That's really important. We have the regulatory reform. If we get the demand side, we will stimulate the UK equity market. And then you might even think that you want to put money into your UK ISA because it might perform really well, rather than because you've been given a £5,000 extra.
That virtual cycle.
Absolutely. Look at the Swedish market. They have changed. Their domestic economy has been much stronger than ours. Part of the reason is because they keep their money at home.
And just as we wrap this up, do we have enough pipeline of mid-cap market or local homegrown companies who I read your report, and you three of a couple of names, the Sterling Bank or Monzo maybe, who are ready to or thinking about going public?
Yes, we do. It always takes longer than people think. And there were various commentators who said at the start of this year, oh, it's a growing pipeline. And we went, rubbish. That is just factually incorrect. Now, we've done 2 IPOs. We've done Raspberry Pi and AOT, and both of those have landed well in public markets. But the reality is the cupboards are fairly bare at the moment. And that's because it takes 6 to 12 months to prepare for an IPO. 2023, how many companies wanted to press the button to decide we're going to spend a lot of time and a lot of money doing an IPO when they go, valuation is rubbish. Everyone's saying, don't try an IPO at the moment because the markets are shut. And if you do want to IPO, go to the States. That dynamic has now changed. And Raspberry Pi is the poster child of this. It's got a very strong list of UK investors. Really important. It's UK investors. It's got a good valuation. The shares have performed well. It's very clear now that the market is open if you've got a good business and are sensible on valuation. And I'm speaking on a regular basis to numerous companies who are now just pressing the button to do an IPO. That means they'll IPO in Q1 next year or Q2 next year. But some really good businesses. We've got some terrific companies. So as long as the market remains stable and we make these changes, I think that we can look forward to some really good companies coming through that are the growth companies of tomorrow. And then we'll stop forgetting about this issue about, the UK, we only have sort of dinosaur companies. I think, we have to make sure that we encourage the growth companies to list and grow and scale in the UK and provide them with the environment that enables that to happen.
And I get all these demand side, policy changes or proposals. Do we need supply side? By that, I mean, do we need to do something more practical for the companies themselves? Creating, or other than the general taxation? Should we give a tax break to a company who IPOs in the UK in the first 2 years of going public?
Brilliant idea. Yes.
Yeah. Okay.
Yes.
What's selfish, by the way?
No. And the reason why it's a brilliant idea is there is a public good about the equity market, and we mentioned one of them earlier: democracy of ownership. That actually is meaningful. The other point is that public companies get scrutinized. Would Thames Water have happened if it had been a public company? Would the post office disasters have happened if that had been a public company? So obviously,
and they get punished brutally if you do anything wrong.
So you are held to account, and analysts like me, journalists, we pore over the results of these companies. We challenge them, we hold them to account, and they have to care intensely about their sustainability credentials. Everything is really focused on that business and how it's performing. And you do not get the same level of interrogation if you're a private company. So it's a public good. Now, that costs money to do all that. So that's exactly why I think you're absolutely right. But also, other countries are now looking at exactly this sort of thing. I think it's Romania that has just decided to provide a tax break if you IPO. So these are not ridiculous things to say. And what we also need to do is reward companies that grow through equity, because those are better for the country. If you are equity owned, you do not worry about your ability to grow through a tough market environment. If you are debt financed, guess what happens if you go into a recession? You have to conserve cash. It's very, very difficult to grow in that environment. So the stability of the economy is much greater through quoted companies that are effectively financed than highly leveraged private companies. So, yes.
Charles Hall, it's been incredibly enlightening talking to you. I have enjoyed our conversation, and I think you have the record on this podcast of 90-odd minutes, and I still want to talk more, but I'm not going to, I'm not going to disrupt. You must come back.
I'd love to come back.
To do this again. So thank you for your time. Thank you for your wisdom. Thank you for the incredible work that you do. I want you to know that he does make a difference. So thank you.
Thank you, Abraham, for your time.
Thanks, John. That's a wrap on today's show. massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.